Hi everyone. One of the most critical things to watch right now is the credit market. The obvious question then is, what on earth is the credit market? Well, it sits in the corner of the institutional world and is really all about the market for corporate borrowing. Now, it's not a market that we come across as private individuals or private investors, but it is an absolutely key indicator at times, and one of those times is now. So let's talk about how credit markets actually work. A company can borrow money in two ways. Firstly, they can go to their bank and ask for a loan and say, hey, I want to build a new factory. I want to borrow $5 million. And the loan officer at the bank will assess the creditworthiness of the company and come up with some terms. Alternatively, and this is more common, particularly in the US, they can go directly to global investors and issue corporate bonds in the capital market. One of the things that's interesting is how the corporate bond market sets the interest rate that a corporate will pay for example, a 5-year loan. The market constructs that rate from two pieces of information. The first piece is they take the risk-free rate. Now, the lowest risk borrower in the world is probably the US government. And so they look at the 5-year US Treasury bond yield as the benchmark for the risk-free rate. Today, 5-year US Treasuries are something like 4.25%. The market then asks, how much more risky is this borrower compared to the US government? And it adds a spread to that risk-free rate. And this is what is called the credit spread. Now, this spread really boils down to how risky the borrowing company is deemed to be by the market. Now, there's a bit of a shortcut here because there are rating agencies. The best-known rating agencies are Standard & Poor's, Moody's, and Fitch. And these rating agencies create a score that categorizes how risky company borrowers are. The strongest borrowers are rated AAA, and slightly weaker borrowers AA and single A, and you have BBB and BBB minus, and so on. And what is also very useful is there are indices that show you the spreads applicable to different borrower. And what is really useful is there are indices that show you how much companies pay in terms of additional spread based on their ratings. Now, we want to focus on companies that are called high yield. And high yield companies are rated BBB minus or weaker. And the high yield credit spread shows us the spread that these companies pay over and above 5-year US Treasuries to borrow money in the corporate bond market for 5 years. Now, when times are tough and the economy is weak, these spreads rise. Clearly, when you're in a recession, the probability of default for lower rated corporates is higher. When the economy is very strong and times are good, these spreads narrow and go lower. And it's interesting that in all equity market sell-offs, credit spreads widen. Now, Quant has built this big machine that ingests loads of macro and market data, and it's looking at all those little variations in asset prices, comparing that to all these little variations in all these macro factors, as we call them. One of those is high yield credit spreads, and it starts to tease out what the market is trading off. And one of the important factors now is high yield credit spreads. Not only that, we've seen in the last few months that shifts in high yield credit spreads are leading moves in equity markets. Indeed, the machine flashed a big bullish signal for equities in early October last year, and if you have a look, you'll see that credit spreads started to narrow quite sharply from around the 2nd of October, and that just continued. Now, even if credit spreads do not lead, it's really useful to know what to look for. We have hundreds of different indicators thrown at us and thousands of different stories and narratives, and it's very useful to be able to narrow it down to, okay, what are the 2 or 3 things I really need to focus on to understand current equity market dynamics and the outlook? And high yield credit spreads are undoubtedly one of those important things right now. Unfortunately, high yield credit spread data is not widely available. It remains very much the preserve of the institutional investors. It is also typically quite expensive to get hold of. But there are 2 places that you can keep track of what high yield credit spreads are doing. First, right here, eyeQ has an investing community on Discord, and in that community, we're constantly updating the movements in the most important factors right now, and that includes high yield credit spreads. And we're also providing some background information, for example, on the data that's coming out on the number of corporate bankruptcies we're seeing monthly in the US. Second, there is a Twitter account we really like called Credit Spread Alert. Big shout out to them for making this important data available to retail investors. I will leave you with one piece of data showing the recent rise in 2023 in US corporate bankruptcies from S&P Global. Credit markets aren't really responding right now to this increase in defaults and bankruptcies, but if this continues to rise, they very likely will. And this will exacerbate the equity market weakness and probably indicate a bear move. Credit markets are not really responding to this, but if this trend continues, we expect they likely will. Secondly, if the Fed's continued interest rate increases start biting on the economy, and we think that is inevitable, then you will see further pressure on high yield credit spreads. Hopefully this has been useful in understanding what people are talking about when they talk about credit markets and high yield credit spreads, and also in underlining how important credit spreads are right now in understanding market dynamics. Good luck out there. Thank you.